Previously, we looked at what moving averages are, the different types of moving averages, and some basic strategies. But over the next few lessons, I hope to teach you some other uses for moving averages. In this lesson, how to use moving averages to find trends, the learning objective is you should understand how to use moving averages to find trends. There are a variety of options when it comes to finding the trend. One of the most commonly used ways of finding the trend is using moving averages. The advantage of using moving averages is its responsiveness and simplicity. With moving averages, you'll be able to know what direction the market is currently trending in very quickly. The direction the moving average is pointing in will give you some indication of the direction of the trend and the strength of the current trend in the market. If the moving average starts to flatten out, the market may be about to enter a consolidation phase. When price action stays above the moving average, it signals that price is in an uptrend and you should look to buy. If price action stays below the moving average, then it indicates that it is in a downtrend and you should look to sell. I would advise you plot more than one moving average on your chart, as this would give a clearer signal of whether the pair is trading up or down. There are also moving average ribbons. Typically, moving average ribbons consist of approximately 8 short-term and 8 long-term exponential moving averages. When your ribbons start to become parallel and evenly spaced, you can assume that the current trend is strong. When the ribbons start widening out and separating, this signals that the trend is starting to reach market extremes and could be the end of the trend. But what do they look like? Let's take a look at moving average ribbon. Here's a real world example. As you can see, there's many different moving averages, and at different points they can either be parallel or they can start to converge or diverge. And you can use moving averages to help you trade, moving average ribbons to help you trade, because when the ribbons start to cross over each other, a trend change has already begun to occur. It can act as an early indicator after seeing extreme levels, because the shorter moving averages will cross over first, while the longer term moving averages will cross over after. So depending on your level of risk tolerance, you could wait for a certain moving average to cross over. For example, let's look at this one. Okay, so the faster moving average would be the blue line, and the slower one would be the dark red line. As you can see, there's a crossover of the first moving average here, at this point right here, and then the last moving average crossover occurs here. As you can see in this example, you wouldn't have missed that much of the trade if you had just waited, but the trade would be much more reliable if you waited for the fast moving average to cross the slowest moving average, or the longer term moving average. Most people incorrectly assume that the only important factor when using moving average ribbons and multiple moving averages is that the crossover or the twist in the charts. The actual spacing of the ribbons and moving averages show the underlying strength of the trend, and often are more important.